So good evening again and welcome to today's webinar with Abojani. And today we're doing this in collaboration with Boost Africa. We're going to be talking about accessing venture capital for businesses, some of the pitfalls that SMEs encounter and how they can really go around that to ensure that they get that funding that they need. And we'll be looking at some of the lessons that Boost Africa has for us. And I'm very delighted to have two expert panelists with us today. And I'll start with Astou, who is the Boost Africa TA facility lead. Good evening to you.
Good evening, Claire. I hope that you can hear me.
Yes, we can hear you.
Good evening, everybody. Good evening, Claire. It's really great to be here today and really looking forward to the discussion and sharing the insight that we got from Boost Africa.
Thank you so much. We're looking forward to those insights indeed. And my next panelist is Adolfo Cires, who is the European Commission Boost Africa lead. Good evening to you, Adolfo.
Yeah, good evening, Claire, and good evening to everyone. Glad to be part of this webinar today and looking forward to share with the audience what is the Boost Africa program about, what are the objectives, what is happening within the program, both from the capital mobilization side and also from the technical assistance side. So I just realized that tomorrow is a holiday in Kenya, so we are competing with the parties, isn't it? It's okay. It's okay.
But I'm sure there are many people who are hungry for knowledge. You know, business continues, holiday or not. So we need those lessons that we can draw from. So to give a bit of background to why we found this conversation very important to have is because, as I mentioned earlier, accessing venture capital remains a key challenge for very many SMEs in Kenya and even Africa. So, you know, there's the issue of high borrowing costs, there's lack of tailored finance products, and so many other challenges that people face, including investor readiness that can hinder growth. So today, we want to just draw some lessons from Boost Africa. It has a program that not only provides funding, but also technical support, because that is sometimes the gap that many businesses face, that technical support, the mentorship, and even networks that can help a business become investment ready. So we'll draw some lessons from that. And so for us to begin this conversation, I think it will be good to understand a little bit more about Boost Africa. And I will direct this question to you, Adolfo, first of all. What are some of the biggest challenges causing Africa, and then draw it closer home to Kenya, that make them lag when it comes to attracting private capital, both locally and also internationally?
Okay, Claire, thank you very much. So, you know, I think the name of the program, Boost Africa, is quite self-explanatory, meaning Boost Africa, what it's trying to do is to mobilize capital for different SMEs in the continent, you know, and in particular also in Kenya, because we can see within the continent and different countries how difficult it is for some SMEs to access formal capital. You know, formal capital either from the banking sector, that is one of the ways that companies get formal kind of access to capital, but also from the funds, from investment funds, from private equity funds, etc. You know, and then we know that in many cases SMEs have to look for alternative ways of financing, because it's either very difficult to access the capital or very expensive, or actually both. You know, so what we have been doing with the Boost Africa program is actually being able to attract more capital into the African continent, you know. And how do we do that? So we focus actually on private equity funds or investment funds that they provide this capital to companies, you know. So Boost Africa program is a partnership. It's actually a European Commission funded instrument where we provide capital both for the European Investment Bank and also for the African Development Bank. And this capital that we provide to both institutions is subsequently invested into different kind of private equity funds. Just to give you a concrete example, you have a fund that is actually operating and it has an office in Kenya that is called Cires. So Cires fund has been invested with capital from the European Commission that is transferred to the European Investment Bank, and then the European Investment Bank invests a certain amount into this fund. The fund, if I don't remember now, is approximately around 40 million euros that invest in different companies. And what we provide to the European Investment Bank is what we call a junior tranche. A junior tranche that actually what it means is that it's a capital provision into the fund that protect other investors from investing into the fund. So with, let's say, approximately 10 million euros that is invested in a junior tranche, you can attract other investors of around 30 million, and then you have a fund of 40 million. And then this fund in investing companies. So that is what is Boost Africa about from the capital side, from the capital mobilization side. But all these funds and companies that are invested by the funds are supported by a technical assistance facility. That is the one that Astou is managing. So she will also talk about that later on. But that is a little bit what is the concept. So what do we achieve by this structure of Boost Africa? Attract the capital that is needed for the SMEs companies in the continent. So it is a combination actually of public money, because European Commission is a public institution that provide a junior tranche to a public bank like the European Investment Bank or the African Development Bank, and then you find investors that co-invest with public institutions, and some of them are private. So what do you achieve by having this junior tranche? But then you reduce the risk of investors to come in, because in the case of Seed Stars Fund, if they end up having losses, the first losses will be taken from the junior tranche. So what we try to do is to mobilize capital. In this case, is mainly international capital, a combination of public and private international capital that goes into a fund that is, in many cases, domiciled in Mauritius, and then invest in companies from offices that they are open in Kenya. So you have several examples of companies that have been invested by Seed Stars in Kenya, and that is a little bit the principle of what we do. When it comes to local mobilization of local capital, well, there is a lot going on now in mobilization of local capital for example, in Kenya. I mean, you have money that is being mobilized from different local availability of pool of capital, and that is also something that is very important, because you have to find a way of mobilizing capital both from international markets and also local markets. So let me just share with you this as an introduction. We'll talk more, but I think this explains a little bit how it works. So we have a number of funds that SMEs can access capital from, that they are part of the Boost Africa program.
Okay. So probably you can tell us some of those challenges that are causing Kenya and Africa in the wider scale to lag when it comes to attracting that private capital.
Okay, one of the things that everybody talks about, obviously, is the risk. When you have capital that is coming from Europe, eventually lending that money or investing in funds that invest in Europe, it looks like it's more secure, because, okay, in case of non-payment or whatever, then okay, you are in Europe, and then you are able to maybe recover some of it. There is this kind of perception that investing abroad, and it's not only about Africa, I mean, it's in general in emerging markets, that they are also in Latin America or in Asia, so it's always a risk to invest abroad. It's always a risk to bring capital from international capital into different jurisdictions, so for sure one of the topics is risk. And then when we talk about risk, you talk about different risks. You talk about country risks, then you talk about non-repayment risk. You talk about issues of arbitration that maybe they are not 100% clear or working, so that influences a lot the mobilization of international capital. But that's why it's important to find a combination of international local capital, because the local capital, when it's put to use for SMEs, then also creates that kind of development in the country. There are now a number of initiatives from pension funds in Africa. Actually, the last month there was a meeting in Uganda where the NSSF of Uganda plus other funds, other pension funds of Africa are looking for alternatives of how they could invest in funds, this type of private equity funds that we have been talking about, and then subsequently they provide capital to SMEs, because there have been a kind of history where many of these pension funds have been investing in asset classes that they were not reaching SMEs, either buying bonds from the government that they are very secure and they are providing good remuneration, or maybe investing in listed companies. But where are the SMEs there? So this kind of discussion and this kind of topic is now becoming more and more important in the African continent. And actually, that is very good news, because when we find ways where international capital join local capital, that is something that will be very beneficial for the continent, for Kenya, for Kenyan companies, for SMEs. So that line of action is now taking place.
Okay, thank you. So risk is a big factor, and risk comes in very many ways. There's that default, which is always a big one, and then that jurisdictional element that you said, and also arbitration. And we'll delve a little bit deeper into that. But Astou, I'd like to rope you in. We're talking about venture capital, but I'd like us to do some comparison. For SMEs, what are some of those practical difficulties that they face when trying to get finance from traditional sources versus now the venture capital that Adolfo had spoken about?
Yeah, thank you very much, Claire. I think that what also Adolfo mentioned is that when we look at formal structured financing, the options are not that many for an SME. You have definitely the classical traditional finance system, which are loans that you can get from banks, or you can have leasing facilities, or many instruments that are offered by classical financial institution. But most of the time, those are relying on guarantees. So you need to bring collateral for you to get a loan. And for someone that is starting, most of the time that collateral will be a personal property, for instance, that you're coming to get a loan for the business. So that's one of the constraints that you might have. Another one is really also the instruments that you will find in the classical institutional or finance institution are for companies that are a little bit more stable. For instance, they would say we can give you advances on contracts, but it means that you have large contracts that you've already secured, and then to manage cash flow, you will have instruments that can help you. But there is not what we call patient capital. Patient capital, which is the one that actually comes when you are grinding, groaning, testing your models and getting into the market and seeing what is the traction of the market. And that's where VC and later private equity come into place, because those are models that come with the entrepreneurs, take the risk with the entrepreneurs, and provide this patient capital that will let the potential of the business be developed before we talk about remuneration, before we talk about getting paid what the money that we put into. So I think that those are the elements that we need to take into account. Another point that is also important is when we talk about traditional finance and venture capital, it's not an opposition. When you're a business, you will need actually all type of funding and financing at different stages. Venture capital is very good when you're starting, and once again, there's a lot of risk, and you have now a partner that is here to take the risk with you and to grow with you. Banks and traditional funding will come later when you have stabilized your business, and you will have to keep those relationships as well because they will fund, as I mentioned, your cash flow or your operational costs, whereas venture capital will be here more to fund your investment and your growth. So maybe those are some distinctions that I can make.
Thanks for that, Astou. And I like the way you said that it's not in opposition. You will need different kinds of capital during different stages of your business. So at the startup stage, you need that patient capital. So you don't need to have headaches of, oh my goodness, the collateral, so on and so forth. But there's a place for different kinds of capital during the journey of your business. So thanks for that. Now, Adolfo, I'd like us to go back to regulatory hurdles. And you spoke to that very briefly when you talked about the issues that come with jurisdiction and so on and so forth. Tell us some of those structural issues and also narrowing down to the regulatory hurdles that are affecting mobilization of that capital for SMEs in Africa.
Okay, this topic of regulation is something that that I like to talk a lot about it, because and this is based actually on reality, meaning on something that I've been going through. I used to be working with the European Commission in Uganda, then I was in Kenya. When I was based in Uganda, one of the programs or instruments that we work on was to set up a private equity fund, actually, because the same thing that is happening with Boost Africa. We wanted to find a way to create a financial instrument that will be able to lend to companies in Uganda. The similar kind of constraints that you face in Kenya, they were also faced in Uganda. So we say, let's try to set up a private equity fund. And we tried to set up a private equity fund that was domiciled in Uganda. But it could be domiciled in Uganda, but you can also set up maybe another one in Kenya. Now, when we did that, and we wanted to raise the capital, because, as I mentioned before, we tried to use our capital as catalytic for other investors. We don't provide 100% of the capital that goes into this kind of funds, because the idea is to have some public money from the European Commission or the European Investment Bank into these funds, but we want to use that capital as catalytic, meaning that attract other investors as well. And then instead of having 10 million fund, you end up having 40 million or 20 million or whatever. So when we were trying to set up this fund in Uganda, we had a couple of regulatory problems, because if you set up a fund in Uganda, we were facing a high capital gains tax. When you domicile your fund in a different jurisdiction, in this case maybe in Mauritius, your capital gains are smaller. I mean, actually are almost near to zero. We also had some constraints on the kind of setup of the private equity fund itself, because there was a lack of regulation in the country on a limited partnership for companies. But mainly the issue of capital gains, for example, was something that it was a challenge, because there was no provision within the regulatory service, in this case, the Capital Market Authority of Uganda, to provide for almost zero capital gains. So that provides with a quite of not very good base for the attraction of capital, because you want to have as smaller taxes as possible to be able to attract investors from abroad. Now, of course, some people may say, but this is actually a problem from the taxation point of view, and we had that discussion with the government. So it doesn't mean that because you don't have capital gains, you don't invest in companies that they pay taxes, because those companies that you invest in, first of all, they employ people. So when you employ people, obviously you pay to the government the taxes of employment of people. And then also when you have profits, you pay your taxes, But if you prevent investors from coming, then you will not be able to benefit from that, you know. So sometimes regulatory situations in different countries prevent from the attraction of international capital, because those kind of specific and special capital gains taxation help on attracting our capital. What happened in the African continent? So Mauritius has become the industry country where they attract funds, they attract investors, and then those investors end up investing in companies in different countries, you know, because they have that capital gains benefits. So this kind of regulations, capital market authority can help attraction of capital, and then therefore then you will have more capital available for SMEs, you know. In the end, what happened in Uganda? Well, we end up setting the fund the way it was. There was a capital gains, if I don't remember wrong, it was, I think, 15%. That made it a little bit difficult for us to find other investors. We ended up getting a co-investment from the NSSF, from the Pension Fund of Uganda. What it was great, because it was mobilization of local capital. You know, NSSF, for example, it has, at least at that time, I'm talking about 8 years ago, 3 billion assets under management. It's a huge amount of money. If they can dedicate few percentage of all those assets under management to invest in asset classes that benefit local SMEs, that will be great for the country. So anyhow, they ended up co-investing with us. And there was also a couple of co-investments from impact investors. You know, now impact investment is something that is also quite fashionable, I would say. We managed to get some impact investor from Finland and another one from the US, and then we ended up closing the fund. So we had difficulties because the capital gains was very high. Now we use that example to talk to the government of Uganda and say, you see, we did a pilot, let's say, of setting up a fund, but the capital gains was taxation was a problem, etc., etc. We did a kind of white paper, a kind of case study, and then through this kind of policy dialogue with the government, they agreed to decrease capital gains for specific cases like these ones, you know, because helps attracting capital. So just to give you an example, regulations affect the attraction of capital. Yes, it is a fact, you know, and is an example of how changing some regulations can help on attraction of capital, both for international but also for local. You know, there is now different regulations from the capital market authorities of different countries. I was talking today to some people in Ethiopia. It seems that the capital market authority of Ethiopia has opened for a new way of collective investment schemes in Ethiopia that will allow the mobilization of local capital for investments also in companies, you know. So these kind of things are very important, you know.
Okay, thank you for that. And I just seen a comment here. Someone was asking for a repeat of the local office name, and it's been written there for anyone who also missed that. It's Seed Stars Africa Ventures, so you can keep note of that. Now, as you said, taxes are always a big issue, and that capital gains tax, CGT, is also an issue here in Kenya. But now I'd like us to talk a little bit about some of those gaps when it comes to investor readiness. And Astou, you alluded to that, but I want us to delve a little deeper into that. And before you talk about some of the gaps for SMEs when it comes to making them investor ready, tell me, are there SMEs that are even taking up venture capital? Are they looking to venture capital as a first option, or is it just a by the way? So what is the uptake looking like? Is it significant? And then tell us, for those who are seeking out that venture capital, tell us some of those loopholes or the pitfalls that prevent them from being investor ready.
Yeah, definitely. So I think that there's been in the past 15 years an uptake and a better understanding of what venture capital is and what it could bring to a company, especially when you look at certain sectors. And for instance, in Kenya, it's very much in the tech sector where you will see a lot of companies that will have raising fund from venture capital funds as being part of their strategy and how they will set up their businesses. But that also is because when you do go for venture capital, there is a growth trajectory that is an exponential growth trajectory. So venture capital is not for everybody. If you're a traditional, completely business that will do 5 to 10% growth per year, and that's the way your business is, your business model is, venture capital is not for you, because venture capital is looking at, I come into your business with 10 and I leave with 100. So an exponential growth, that is not the pace that all type of business model have. But those who do have that, they are now conscious of that opportunity that venture capital offer, and they are seeking and looking at, and I think that the question that was in the chat gives you an example of the interest, at understanding who are the players in the market and who are the venture capital firms that are investing into African businesses, whether they are tech businesses, startups, or SMEs. Now, once they have this interest, what we do really see, and we see it across the board in Africa and also in Kenya, is, as you say, a gap between the language and what a VC is looking for and the level and the preparedness of the enterprises. And there are many elements on which they need to grow to be attractive for those VCs. The number one is really, and I think that we see it across the board, is the numbers. Meaning, what is your financial structure? Are you able to talk about your key indicators and unit economics? Are you able to really make a case of that exponential growth that we're talking about? Yes, you have a market. Yes, you have a business, but how is that going to grow fast and very fast in the next year so that it is interesting for a VC? The other element is and we've seen it also with Boost Africa as we're coming with technical assistance, is the talent. You build a business and you build it quite well for it to serve, I don't know, 10,000 users. With your VC investment, you're looking at 10 million users. How is your organizational infrastructure and the people in your organization supporting that growth that you're going for and that you're requesting investment for? So that's number two. Number three, we also see it a lot, and we've worked with a lot of firms to help them improve that, is also the tech infrastructure. If you talk about tech businesses, it's really how do you build for growth? How do you make sure that from the beginning you have the processes and the infrastructure that will allow you to absorb these 10 million users that you'll be going for? And so those are elements that I would say need to be taken care of as you are looking for funding from VCs. And of course, there are programs and there are opportunities for you to grow and be supported as you become more investor ready. And beyond Boost Africa, I think that also what we've seen especially in the Kenyan market, is a growth of the incubator accelerator space. And those are also structures that are supporting businesses and founders to better understand what are the requirements of VCs and to get ready to receive investment from the VC. Not only, I would say, receive investment, but also that the relationship with the VC works well. Because we're talking about patient capital, but patient capital, what it means is that you will have an investor that is going to be with you and be on your back for 5 to 7 years. So are you able to take on also that fast pace and that scrutiny that will come from your VC investor? So those are the points I would put in.
Okay, thank you so much. And I think that's a very important points that you put across, especially that one for the exponential growth, because sometimes if you know your business is, as you said, the 10 to 15%, then maybe it's not for you. So you're looking for exponential growth. So you need to really analyze your business and see, okay, what kind of capital best suits me? So I think those are very good points that you've put across there. Now, Adolfo, I'd like us to go back to that issue of risk. And really delve deeper about how Boost Africa is really putting in place the structures when it comes to investment and policy that can help really support businesses. And what have you seen as some of the most effective ways of supporting SMEs that is shifting that perception of risk when it comes to SMEs?
Yeah, thank you, Claire. Thank you. I just mentioned it in the very beginning. I mean, the most important part of Boost Africa when it's coming to capital mobilization is the junior tranche provision. Is the kind of first loss protection to other investors. That is very important because when the European Investment Bank or the African Development Bank are investing in some of these funds, providing a junior tranche a first loss protection, that means that in case of losses, whoever comes as a senior tranche, they will not be affected by losses, and that is very important because that secures the investment of those funds. See the Stars is an example of it, but we also have other funds within the African continent that have been benefited by these junior tranches of Boost Africa program. I will share the names as well in the chat, but you have Django Capital that invests more in the western part of the continent, and Atlantica Venture Capital Fund. Those three, See the Stars, Africa, and Atlantica Venture Capital Fund, plus Django Capital Startup, three of them have been set up thanks to the junior tranche provided by the Boost Africa program, and the multiplier effect that we are talking about before, because it de-risk and then it attracts other capital. We have been focusing more on See the Stars because we are talking in Kenya, and then See the Stars has an office in Kenya, and See the Stars, we will maybe talk later about it, but it has at least 3 companies that have been invested that they are operating in Kenya. We have Poa Internet, Shamba Pride, so you have different examples of companies that have been invested through See the Stars. The other funds, Django, for example, is more focused on West Africa, but Boost Africa is a continental program. I think that Kenya is quite lucky in many ways because you have a kind of maybe a better business environment than other countries, and then you end up attracting a bigger chunk of the money into Kenyan-based companies, compared to other countries that are perceived as more risky. So yeah, that is actually something good for Kenya. So when you compare the country risk and the business environment and the protection in case of non-payments, plus also the projections of growth of the country, Kenya is a country that is attracting a lot of private equity money. But I would say the key on Boost Africa program is the junior tranche, is the first loss protection. That is the one that attracts other investors. That is a combination of maybe other public institutions, but also private. You have now more and more private investors that they are different types. Some of them are foundations. Some of them are maybe private companies that they have a ESG policy of investing in emerging markets. You have also impact investors in general from different places, plus you have all the variety or local capital available as well. So the junior tranche is the key. That is the one that de-risk and allow mobilization of other capital.
Okay, thank you very much for that. And now we've been talking about the SMEs, and I'd like us to talk a little bit about the fund managers as well and the kind of support that they get. And Astou, I'll direct that question to you. I'd like you to explain to us how Boost Africa, their technical assistance that they're giving to fund managers to make sure that their fundraising capacity is strengthened.
Definitely. I think that something that Adolfo mentioned is okay. With that junior tranche, we are de-risking for other investors, but those other investors still need to be convinced that the team that they're investing in and the fund that they're investing in are able to realize their investment thesis. And so as Boost Africa, what we come with when it comes to the technical assistance is to strengthen the team that is doing the investment. And when we talk about strengthening them, it comes into different, I would say, elements. The first one is really how do we make sure that they are structuring a fund that is the most attractive for LPs. And this is both in where it is domiciled, how it is structured in terms of governance, what are the, how is the investment thesis even sharpened so that in the way that they are clear in the problem that they solve, in the hedge that they are bringing to the market. There are now many VCs coming into the market. So what is their differentiation? Or do they know better the market that they're addressing? Do they have linkages to those markets that ensure them that they can have a viable pipeline? So those are the elements that we will be working with them to sharpen their thesis and their positioning. The other element is really the internal processes. Most of these teams, they will start with general partners that are 2 or 3 people, but then they are trying to raise 40, 70, 100 million. So how do they structure their investment team so that it reflects the ambition that they have? How do they put in place investment committees, investment procedures that are up to the standards of the investor that will come into the fund? And also, because we're talking a lot about some of these LPs being interested in impact, how do they structure their ESG and impact frameworks in a way that makes sense for the LPs? And then the last one is, once again, Boost Africa, for instance, will come to the risk, but there is still a lot of work that needs to be done to do fundraising. Some of the funds that we've mentioned, they did their first close, for instance, but they still haven't fundraised all the money that they want for the fund. So Boost Africa will also help them in that fundraising process, both in terms of helping them with their material, with their data rooms, but also because there's this community and this network, providing support through other LPs and other VCs. And there's something that we organize and we've been organizing for 3 years now, which is the Oxford VC Week, which is a week where these VCs that are interested in Africa, working in Africa, will meet to get some of the learnings and the best practices on how to structure their funds. But also there is one day that is really them meeting the LPs and hearing also from the LPs the feedback. Exactly the same thing we're saying about companies. Are you investment ready? What would make them investment ready? What is lacking in the way that they structure or in the way that they're presenting themselves that is preventing other LPs from coming into the fund? So Boost Africa helps the fund manager with all those elements.
Okay, thank you. And speaking of learnings, just to stick with you a little bit, Astou, I'd like us to speak a little bit about mentorship and networks, because at the beginning of this webinar, we said that that's one of the things that Boost Africa really provides. So beyond the funding, when it comes to networks and all that skill building, what are some of the things you've seen have been most beneficial for SMEs?
Yeah, I think that as I mentioned, there's really this element of how do you support the SMEs that do have a viable business model, that do know what they're doing, into speaking the language of people that could be their partners and could be their investors. So a strong element of what we're doing, and especially when we talk about investment readiness, is how do you understand and know your numbers and able to pitch your business in a way that is convincing for investor. That's number one. The second element that really also makes a difference when we talk about the SMEs is how do you have this clarity and alignment between the growth, once again, that you want to have and the strategy that you put in place to execute on that growth. And that's also something that Boost Africa will help them with, both in terms of bringing mentors or people that have worked that way to work with them to structure an execution plan that makes sense and that is aligned with the strategy. But also, once again, I mentioned, for instance, talent. One of the big struggles of SMEs would be, as they grow, how do they find talent that are senior enough to actually accelerate that growth? So Boost Africa will come and help them in designing a talent acquisition, retention, and growth strategy that aligns with the ambition that they have. The other element is really finance, 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 finance. Because whether it is before investment or post investment, at the end of the day, your financial and your numbers will be the thing that say how well your business is doing. And so a key element on which we've been working with almost all the companies is how do you structure your finance processes in a way that they not only give you or make the numbers speak, but that you can use those numbers for strategic decisions, that you can use your number to change your execution, that you can use your number to tell a story to your investors, and that's also another element. And the last one, you mentioned it, it's networks. The same way we are really seeing the power of networks at the fund level, we also see that all the companies at the end of the day, they will be struggling with the same key elements at different scales and at different moments. But there's a lot of peer learning that can happen within the companies themselves. And something we've seen and encourage also the VCs to do a lot more of is these portfolio days, where they bring the companies that they've invested in for 2 or 3 days to discuss their issues. And actually, there's a lot of learning that is happening in those spaces.
Okay, I think you just answered the question on mentorship. I think I must have missed a bit of that. My
Yeah. So in
side
terms of
had a bit of...
in terms of
Okay.
mentorship, what Boost Africa does is that in the way that we intervene, we have three types of interventions. One, which is what we call bespoke technical assistance, which is basically a very tailored intervention by an expert that is here to help you on what specific issues you have. It could be I need to redesign my board because it's not effective, so an expert will come and redesign the board with you. It could be my IT infrastructure is not supporting the growth, so I will have a senior consultant come and work with your team to not only redesign your architecture, but also train your teams so that they can go with that architecture. So that's bespoke TA. The second element is really the learning. Then the learning, we are structuring it around the big blocks that we see that are common and cross-cutting across the companies. So it could be, once again, for instance, the CFO module, which is very much how do you structure finances from A to Z so that they can give you not only the data, but also, once again, allow you to report to your stakeholders and to your investors. And the last intervention part of Boost Africa is the mentorship. So you once again, you are growing businesses in Africa, but people have done and grown businesses in Africa before you. So how do we link you to people that have walked the way before and that are able to really quickly identify the mistakes you're making and they've already made, and bring you the solution quickly. So that's where the mentorship part comes into play. And it can be mentorship because they've walked away in Africa, but it could be a business that you're replicating or that you're doing and developing in Kenya, but has been developed, I don't know, in Cote d'Ivoire or in South Africa. How do we bring someone who has that knowledge to work and help you as you develop?
Thank you for that. And as you said, there are people and there are businesses that have done this before, so you don't have to start figuring things out from scratch, which is very important for businesses. Now, Adolfo, I'd like us to switch and talk a little bit about sustainability, because sometimes there's a lot of focus on the short-term funding. But tell me how the Boost Africa program is ensuring that we not only get funding in the short term, but we have sustained growth in the long term.
Yes, Claire. No, thank you for that. Thank you for that question. Yeah, maybe I didn't mention that before, but when we're talking about the need to have more capital available for SMEs in Africa, in Kenya in particular, is not only about any kind of capital. I mean, you can have short-term capital needs for your business, a kind of working capital needs, but you also need to be able to access capital that finance your capex, meaning your capital expenditure, meaning you need to have a patient capital that fund the needs of the SME that they are more related to the capital expenditure needed for running the project, the company, so this kind of capital that comes from these funds is that kind of patient capital, is that kind of patient capital that provide a combination. It's normally a combination of capex and working capital, so that is what comes from these funds. By the way, I've seen that people were asking, no, for the specific names of the funds. I think that we have shared now. They have been shared now in the chat. So these are examples of funds that they provide capital to different companies in Kenya, and that is the kind of capital that they will provide. It's a different capital from a bank, because a bank will give a loan and then it gives you the conditions, it gives you your term sheet of payments that they are okay with different kind of interest, but you have a clear schedule of when you have to pay. Venture capital funds and private equity funds, they have a different way of lending to companies, because sometimes a company need maybe a kind of grace period for payments or for interest. These kind of funds as well, they normally get a position in the board of the company, and they not only provide debt, they do a combination of instruments. Sometimes it's debt, that it also has a component of profits or EBITDA, or they have also safe agreements. They have also different kind of mezzanine provisions like convertibles, or in some cases as well, they buy equity and shares of the companies. So each kind of agreement or decision of investment in companies through these funds is different. And because in many cases these funds, they take stakes or shares of the companies, then they end up and being part of the board. But they end up being part of the board not only, I will not say to control the company, it's more about providing advice on how to run the business and make the business grow. Because once you have a private equity fund or a venture capital fund investing in your company, you are partners in the progress of the company. It's not like the bank. The bank will lend to you and then you give the money back. And as long as you give the money back, the bank is happy. But if the company, it doesn't perform well, it's not the business of the bank. But that is the difference with venture capital or private equity. The business of the company and the growth of the company benefit as well the private equity fund. And that's why everybody normally works together to make the company grow. And in addition to that, you have what Astou has been talking about. You have also a specific technical assistance that is managed by the Astou's team, where they provide support not only to the funds, as he was rightly talking about, because the funds, they also need sometimes support on making their operations better, and improving in different ways how they perform. But you also have a technical assistance to companies that have been invested by the funds, and that technical assistance, much better the details as to you can maybe provide examples of what are normally these companies demanding from your technical assistance. But that is also very useful, because the combination of capital, then the combination of having one of the investment managers of the private equity fund sitting in the board of the company, together with technical assistance provision, normally has very good effects on the performance of the companies. So yeah, this is a different kind of capital. This is a long-term patient capital, and I think that answers a little bit what you were asking me about sustainability and support to the companies, etc.
Thank you for that. And I like the way you said sometimes people think that some of these managers sitting on the boards are trying to just take control of the company, but it's not for that. They have an interest in the success of the company, so it's for your own good. Unlike a bank, which just gives you money, it's transactional, you pay, everybody's happy. Here they are interested in your success, so that's a good way to look at it. So Astou, you could probably speak to what Adolfo said, that issue of the technical assistance, and then as you speak to that, also tell us some of those practical strategies. I know you've mentioned it throughout the webinar, but is there any other 1 or 2 points that you could tell to SMEs who are looking for funding? What are some of the things that people who have successfully gotten that capital from Boost Africa have done that they could borrow a leaf from?
So maybe I think that in terms of the type of the demand that we got from the companies when we say that Boost Africa was there to support, was really around anything from help us refine our strategy to help us fix very specific operational problems that we have. I'll give you an example. We've worked with a company that was in Ghana that does everything that is around. So it's an ERP that helps small businesses with managing all their operation from supply chain to sales, and that also wanted to add a credit element to it. So connecting those SMEs to banks that could give them loans to help with cash flow issues. We came in as Boost Africa first to help them understand even what is the need of these SMEs that they wanted to support, and what is the appetite for banks to actually work and partner with them to provide those short-term loans to SMEs. And Boost Africa helped, and they were exploring. So they're based in Ghana, and they were exploring Ghana and Nigeria. So Boost Africa came to really help them better understand the market, better understand the opportunity, and also drive and build some of those partnerships with banks that were working across both countries. That same company, once that has been, I would say, validated as a way forward with the fund, came back to Boost Africa to now say, I'm realizing that the IT infrastructure that I have was not built for this new product offering that I have. And I don't have the senior capabilities. I don't have people that have done that before in my market. How can we help me source someone who can help with the architecture and that can also train my team? Because one of the point of Boost Africa is we're not here to do things operationally and leave. The point for us is to come to bring the capability and to leave the capability within the firm. So to have counterparts and people that we are training that are able to continue the business. So once again, that same company moving from something that were more market research and strategy, we then did a lot of work around the IT infrastructure and the platform, and how do you connect and integrate the platform to the banks that they're working with, and then training the teams for them to be able to implement it. So that gives you an example of very clearly how we come in and how we come in and support. And then the second point was what prevents I would say sometimes company from getting to the next level, or once you've received that support, once you have that clarity, what can still hinder your growth. And I think to that what we've seen is two main elements. One is there might be a market, there might be capabilities that we're building, but there is a shortage or a limit in the funding. So you've received funding from one VC, you're working toward growth, but additional funding is required even sometimes to fuel that growth. And as I was saying, that's where also you cannot just be I'm VC and I'm VC only. There is a need for you to identify what are other alternative and complementary funding initiative or opportunities that you can tap into, because those will help and those will sustain. As much as the VC is here for success, they also don't have the pockets. If their investment was 1 million, it's not sure that they can add another million because now the need is there. But they can help you and they can support you in finding someone else that will bring that other million. So I think that from what we've seen, that has been one of the main pain points, and how diversifying the funding and getting alternative and complementary funding has been could be an issue. And maybe the last one, once again, I think it's really, and I'll go back and I said it a lot, is talent. Most of the companies that we've invested in, or Boost Africa has invested in, or in the space, you have a team of founders, of one or two founders that are here from the beginning. And sometimes they are not the one that can take, once again, the company to the level Z. And that has proven sometimes hard for both the fund and the company to come to that realization and to make the adjustments in the organization to make sure that the growth that is the growth potential is actually realized. And I think that's something else that we've seen throughout Boost Africa.
I think you've just really emphasized that need for complementarity of the funding. So don't just depend on that, because if they had that $1 million, they cannot necessarily give you more just because the need is there. So those are good things to factor in, and that talent, because sometimes the person who got you here or the team that got you here may not get you there. So I think those are important points to note. Before we talk about some of the innovations or the sectors that you see are most likely to get the funding? Because you talked about like the ERP company. I'd like us to sample some of these two questions that are in the chat box. And the first one that's around risk, I'll give to Adolfo. So Edwin Bogwa says, hello, thank you for this webinar. My question is on risk calculation. What determines the ROI of VC? How is the ROI recouped from the SME while protecting the SME business? Adolfo, you can take that one.
That is a very interesting question. Thank you, Edwin, for that. So just to break the acronym, because we use a lot of acronyms and maybe not everybody understands or knows what is ROI. So ROI is return on investment. There is a simple formula that is net profit divided by cost of investment multiplied by 100. That is normally the way you calculate the return on investment. So how the funds make their profit, if that is what Edwin is asking. Okay, so it's going to depend on, and I will just try to make a simple case. So you have one case that will be a debt provision, and then another one that is an equity provision. So if the fund provides debt to the SME, that is what the funds call a self-liquidating instrument. And that one's the result of investment is basically related to the interest rate applied to the debt. So it self-liquidates, is also providing a clear kind of a schedule of repayments, and it also provides the security to the venture capital fund on how much is the result and the return on investment on that particular operation with that SME. So that is one way. Very similar to a bank, but a bit different in the way that a venture capital fund or a private equity fund, sometimes what they do is to provide, I mentioned it before, maybe a grace period, or also to provide a combination of the debt with a percentage of the EBITDA, for example. So it's a kind of mezzanine. But basically with the debt, you have a very clear ROI because it's part of the debt. When you invest in equity, it's a bit more of a gamble, because you can buy shares of a company, and then the shares, the value or the valuation of the company today is X, I don't know, whatever. And then, of course, if the company performs well, in 5-10 years, the value of the company, the valuation, and therefore the value of the shares is higher, but sometimes it's not. It depends. Companies, as you all know, if the people are here in the situation of companies can vary. You are also depending on many different external actors. You have competition, etc. Blah blah blah. So the value of a share and the way that you can sell it is a bit unpredictable. So the ROI can be calculated based on the final sale of the shares. But something that happens as well in some of the markets in Africa is that exits are complicated because you don't have an easy buyer for your shares, because one of the ways for an exit is for a company to get listed in the stock exchange, but we are talking about SMEs, so normally that will not happen, So the ROI of an investment in equity is a bit unpredictable. I don't know, but for sure, what you can be sure is that the SME business is protected. I mean, it's protected in some way. Okay, you have a debt, you have to repay, but when you have equity, you are protected in the sense that the investment of the VC is part of the company. Sometimes the owner of the SME can also buy the equity. That happens in several cases. If the company is making good profits and you have enough cash, then sometimes the owner can buy back the equity from the fund. So I think the question is good, but normally, as I mentioned, these funds, they don't cannibalize on companies. But of course, there are cases where the SME doesn't repay by a debt, and then that creates also a lot of problems for the funds. Anyhow, I hope that answered more or less the question.
Yeah, thank you. Thank you. And Astou, I'll give you this other question as you also speak to us about some of the sectors or innovations that have the most potential for attracting venture capital funding in the next 5 years or so. So Marori says, at the point when the SME is now speaking the investor language after Boost Africa support, do they also offer transaction advisory services once they lock a VC fund for the SME?
So the way Boost Africa works is that we provide support to the portfolio companies or the pipeline of the funds we've invested in. So as Adolfo was saying, we've been working with 6 funds over the past 5 years. So the portfolio companies of those funds or their pipeline companies are the one that will receive our support. So we don't intervene in the transaction itself. We do either, if it's a pipeline company, the investment readiness support, or post-investment, we will help with, as I mentioned, strategic or operational elements. So we don't intervene in the transaction and transaction advisory itself. There are other firms, and also maybe that's one other question that was in the chat. What are the structures that can help you within your journey? So there are in Kenya companies that are focused on advisory transactions. So what it means is that you will go with them to them and say, okay, either they can even help you with the fundraising, meaning work with you in terms of structuring your deal and putting you in touch with potential investors, and they will also play that role of transaction advisory. But that's not what Boost Africa does. In terms of the sectors that we see that are the more attractive to VCs, as I said, because a VC model is a VC where high exponential growth is required, those are also sectors where you can see this type of growth happening. In the past 5 to 7 years, it has been very much focused in tech, whether it is fintech, AssureTech, EdTech, learning with tech. So everything that was kind of a tech background, because that's where you see those high growth rates. And tech is not tech out of the blue, it's tech that is coming to enhance a traditional business and a traditional business basis. So that's number one. Number two that we're seeing a lot lately is everything that is around climate smart agriculture, around tech into the food systems. So how do we reduce post-harvest losses? How do we increase productivity? How do we increase resilience for farmer using technologies and innovations that are around technology? So that's a sector that is not only interesting for VC, but also where you're seeing also a lot of donors also supporting SMEs. And the last one would be everything around green energy and mobility. You've also seen a lot of VC and private equity firms interested in supporting those sectors. So that's what I would say in terms of sectors.
Okay, thanks. And we're coming to the closing of this webinar, but there's another question here, and probably I'll give it to Adolfo. Roger Skiplimo is saying, what are the investment firms in Kenya doing to support the younger generation, and how can that younger generation become part of those firms? Adolfo, can you take that?
Yeah, very good. Very nice question. I cannot see it in the panel, but it's okay, no problem.
It's in the
Well,
Q&A.
we spoke about it a little bit before. I mean, SMEs are the backbone of the economy of the countries everywhere in the world. I mean, it doesn't matter. It's everywhere because they create employment, So employment of all kinds, but for sure employment of younger generations as well. People need to have jobs when they finish whatever they do, school, or when they go to college, or when they do their own other form kind of skills training or whatever. People want to have jobs, and the ones that provide jobs is not only government, it's also SMEs. I think that in Kenya there has been a very good kind of process that is coming from the past, where the private sector has improved and grow a lot, and there are several companies. But this kind of venture capital and private equity funds, what they do is they provide this capital for more companies to be created or to grow, etc. And that translates into employment. We talk a lot about impact, but what better impact is there than create employment? That is the best one, So you have that angle. Of course, younger generations also create companies. They create startups companies, and those startup companies they grow with different kind of capital, and then they end up in many cases being invested by these kind of funds. So I'm pretty sure that some of the companies that they are part of the portfolio of some of these funds, you can see several entrepreneurs that they are part of younger generations. Although we also have to be realistic, some of these funds are not small. They are not the small funds. They provide ticket sizes of, you have different ticket sizes, but in many cases are around 500,000 or $1 million. But you also have other kind of funds that they are smaller, that they support the startup. So in general, what I can say is that Boost Africa initiative is trying to provide capital, setup of investment in funds, in different kind of funds as well, and that translates into more opportunities for younger generations.
Okay, thank you for that, and really reiterating Boost Africa's role in this whole ecosystem. So we're coming to the close of this webinar, and I'm sure all your questions have been answered, and we've really gained a clarity on what it takes to access that venture capital, and if your business is actually the right kind of business to secure that funding. And now you know that it's different kinds of funding that you will need. There's complementarity. You don't have to be fixated on one element. So as we close, I'd like to just get closing comments from both you, Astou and Adolfo, and I'll start with you, Astou. For all our listeners today who are business owners, SME owners, what is the one thing you would like to leave them with when it comes to that securing of venture capital funding? I know you've said a lot, but if there's one thing that you would like to leave them with, what would that be?
Yeah, so I think that, and also answering to or seeing the type of question that we've seen in the chat, it's a chain of support. So Boost Africa comes at a certain stage, which is when you've received investment from one of the fund that we're supporting. But before that, you have a whole ecosystem of incubators, accelerators, transaction companies that are here and that have programs and support system for entrepreneurs. Whether you just have an idea, or you have an MVP, or you are already on the market, or you're looking to scale, I think that great that you came to this webinar, but also seek out in the ecosystem. And in Kenya, I know there are really many. I think that more than 30 incubators and accelerators that are active in the market and that are supporting you at these different stages of your growth. So be curious, do approach them, and most of them, they have programs that are funded by donors like the EU and other donors that are here to support SMEs, startups, because we all believe that once again, building the private sector and a strong private sector is what's going to make the country advance. So please seek out those opportunities, and if you have any questions, you can of course reach out, and we'll be happy to direct you.
Thank you for that. So just be curious, and probably you can answer this last one. I can see there's one more question that has come through, so you can briefly speak to Marori, who's asking, does Boost Africa also provide tech support for startups and match them to potential VCs for CapEx?
No. So that's why I'm saying that because Boost Africa, we work with pipelines of VCs, we will support, for instance, companies that have already been identified by the VCs as potential investees, but will not support out of the blue companies that just come to us. And that's where I say that there are other programs that are here to support this type of companies. And most of the time, they will advertise on their networks that they have programs available and that they're recruiting, or you can send your application to be part of a program that will support you not only on the tech side, but also on the business side, for you to be able to then talk to VCs and investors.
Thank you for that. I'm sure, Marori, that is clear for you now. And last but not least, Adolfo, what would your closing comments be to all those SME owners who are seeking a venture capital?
Okay. I just wanted to focus on a couple of things that we have been talking in the last 1 hour, that it is important for SMEs to realize that their own government, they have a role to play, meaning, and we spoke about regulations before. Certain regulations support the development of SMEs and the access to capital, that is one thing that the companies have to take into account. The governments have a role to play. I mean, this is not only about now the European Commission coming with the European Investment Bank and then investing in funds. I mean, we are happy to do that because we believe also in the in the power of capital and investing in SMEs as a job creation kind of instrument, but the governments have a role to play. Then, Astou just mentioned it, this is a kind of ecosystem that is all interrelated. You have incubators, accelerators of companies that support the companies in the growth path. What we try to do here is to support the mobilization of capital, as we mentioned before, different kind of funds, from smaller to bigger, also sometimes also dealing with the banking sector. But one remark that I would like to do is that the local capital is very important, the mobilization of local capital for the support of the SMEs. We can come in and work together with local capital is fine, but local capital to put at the service of SMEs, and that means at the service of people of Kenya that are entrepreneurs, is very important. And I'm talking about pension funds, collective schemes, people, high net worth individuals that they can invest in different kind of instruments that they end up in SMEs, So that would be my message. I mean, it's good to have the European Commission, the bank, whatever, working on this, but local capital is important, and that kind of policy dialogue between SMEs and the government and different local capital providers is important, because in the end, there is capital available in Kenya. There's a lot of capital available. If it goes more and more into the hands of SMEs to be able to develop their companies, that is great, and we'll be happy to do that together.
Thank you so much. So yes, at the end of the day, local capital is also very important. The comments there, they're saying much appreciated. Grateful for the conversation, guys. Thanks so much. If you missed any part of the conversation, it will be available on the Abojani Telegram page. So look out for that. Also look out on the X page, and you can also find out more about the Boost Africa program on the Abojani page. They'll be posting a lot on that, so you can find out and be curious, as Astou said, find out what is relevant and most useful for you. So I'd like to thank you so much, Astou and Adolfo, and the Boost Africa program, for just coming and sharing with us all that we need to know about securing venture capital and really understanding what will work for our businesses and what will not work for us. So as I said, if you missed anything, you can always listen to the recording that will be made available. And as always, remember that Abojani will be having its masterclass in January. So I know it's holiday season and people are already kicked into the December holidays. So let me wish you a good holiday season in advance, and then we will be back 2026 to boost our businesses, right? So thank you again.
Thank you so much, Claire. Thank you, everyone. Thank you, Adolfo. Thank you, Alison. Bye-bye. Ciao.